Most people think they are smart. They buy a few silver coins, maybe a small gold bar the size of a chocolate square. They put it in a drawer, and then they sit back, they fold their arms, and they tell themselves, "I am safe. I am protected. I am a financial genius." Let me tell you the cold, hard truth. You are not safe. You are delusional. Owning a token amount of precious metals in the face of what is coming is like bringing a plastic umbrella to a Category 5 hurricane. Sure, technically you have an umbrella, but do you really think it is going to keep you dry when the ocean falls on your head? History is littered with the corpses of investors who thought they were prepared. In every major monetary transition, from the fall of Rome to the Weimar Republic hyperinflation to the 1970s stagflation crisis, there were always people who saw it coming. They bought the right assets, they bought gold, they bought silver, and yet they still got wiped out. Why? Not because they were wrong about the direction, but because they were wrong about the magnitude. They owned too little. They owned it incorrectly, or they sold it the moment the price dipped because they had weak hands and even weaker stomachs. We are now moving toward the year 2026, and let me be crystal clear. This is not a normal economic slowdown. This is not a standard business cycle recession where GDP dips for 2 quarters and then the Federal Reserve prints some money and everyone goes back to buying overpriced lattes. No, what we are entering is a structural transition. This involves the complete saturation of global debt, the breakdown of trust in fiat currencies, and a liquidity crisis that will make 2008 look like a picnic in the park. In this kind of environment, vague exposure is not the same thing as real protection. Having 1% of your portfolio in gold is not a strategy. It is a souvenir. It is a hobby. It is not insurance. The reason we are having this conversation right now and not 5 years from now is because positioning for safety must be done before the stress becomes obvious, not after. Look around you. Look at the average man on the street. He is sleepwalking. He thinks the government will save him. He thinks the central banks have a plan. He believes in the fairy tale of a soft landing. He is the prey, and the financial system is the predator waiting for the right moment to strike. By the time the majority of these people feel unsafe, by the time they realize their money is melting like an ice cube in the sun, the opportunity to position yourself properly will be gone. The doors will be shut, the premiums will be sky high, and the physical metal will be unobtainium. This is why the question is not whether gold and silver matter in the year 2026. That debate is over. The smart money already knows the answer. The central banks are buying gold hand over fist. Do you think they are doing that because they like shiny rocks? No, they are doing it because they know the math does not add up. The real question, the only question that matters for you and your family, is how much is actually enough. How much is enough to make a difference between poverty and survival, between survival and prosperity? Because there is a massive gap between owning metals symbolically and owning them functionally. And that gap, that wide, terrifying canyon, is where most people get caught off guard. To understand what enough even means, we first need to strip away the myths. We need to be brutally honest about what gold and silver actually are. They are not magic beans. They will not grow to the sky just because you want them to. They do not prevent volatility. In fact, as we will discuss later, silver will likely give you a heart attack with its volatility before it makes you rich. They do not eliminate risk. What they do is protect purchasing power. They are the only financial assets that are not simultaneously someone else's liability. When you hold a bond, you hold someone else's debt. When you hold a stock, you hold a claim on a company that relies on the system functioning. When you hold cash, you hold a promise from a government that has a history of breaking promises. But when you hold gold, you hold the final settlement. But here's the catch. Insurance only works if it is sized correctly relative to the risk it is meant to offset. If you have $1 million house and you buy an insurance policy that only covers $10,000 of damage, you are technically insured, but effectively, you are ruined if the house burns down. The risk profile heading into the year 2026 is unlike anything most people alive today have ever seen. This is not just about unemployment ticking up. This is about the sovereign debt of the most powerful nations on Earth becoming unpayable. Governments are carrying debt loads that cannot be serviced without either sustained inflation, which steals your wealth slowly, or financial repression, which steals your wealth quickly. Central banks are trapped. They are caught between protecting their currencies and protecting the asset markets. And history shows us, when forced to choose, they will sacrifice the currency to save the bond market. They will sacrifice your savings to save the banking system. The choice has already been made. They have chosen inflation. They have chosen to devalue the currency you work so hard for. So, ask yourself, is your little stack of coins enough to stand against the tidal wave of currency debasement that is coming, or are you just pretending to be prepared? In the next part, we are going to expose the debt trap and the absolute clown show that is modern monetary policy. We are going to look at why the people in charge are terrified and why you should be too. Let us stop pretending and look at the math. Mathematics does not care about your feelings. It does not care about political parties, and it certainly does not care about the speeches made by men in expensive suits. The core issue heading into the year 2026 is debt saturation. We have reached a point in history where the debt loads of sovereign nations have become mathematically impossible to pay back in real terms. The United States government alone is adding trillions of dollars to its debt pile every single year. We are not talking about wartime spending. We are not talking about crisis spending. We are talking about just keeping the lights on. Interest payments on this debt are now consuming a larger portion of the national budget than the Defense Department. Think about that. The greatest empire in modern history is spending more on paying interest to bondholders than it is on its own military. This is what we call a debt spiral. And once a nation enters a debt spiral, there are only two ways out. Option 1, a hard default. The government admits it is bankrupt. It stops paying. The system collapses. Pensions vanish. Chaos ensues. Politicians hate this option because it usually ends with them losing their jobs, or worse. Option 2, a soft default. This is the insidious path, the cowardly path. They print money to pay the debt. They devalue the currency so that the debt becomes worthless in real terms. They pay back the bondholders, but they pay them back with confetti money that buys half as much as it used to. Guess which option they are choosing? This brings us to a concept you need to understand called financial repression. It sounds technical, but it is actually very simple. It is grand larceny. It is theft. Financial repression is when the government and the central bank conspire to keep interest rates below the rate of inflation. Let us say inflation is running at 5%, but the bank only pays you 3% on your savings. You are losing 2% of your purchasing power every single year. You are being taxed on your savings, but nobody passed a law. Nobody voted for it. It is invisible. It is silent. And it is deadly to your wealth over time. As we move toward the year 2026, this is not just a risk, it is the official policy. They have no choice. If they raise interest rates high enough to actually stop inflation, the government goes bankrupt because it cannot afford the interest payments. If they lower rates to save the government, inflation explodes. So they are trapped. They are trapped in a prison of their own making. And this is where the hypocrisy becomes truly laughing out loud funny, if it were not so tragic. Listen to what the central bankers say about gold. They call it a barbarous relic. They call it a pet rock. They say it yields nothing. They mock you for holding it. They tell you to trust the fiat currency, to trust the system. But look at what they do. In the years 2022, 2023, and 2024, central banks around the world bought more gold than they have at any time in the last 50 years. China is buying gold. Russia is buying gold. India, Poland, Singapore, Turkey. Even the Western nations are repatriating their gold, moving it back inside their own borders. Why? If gold is a useless relic, why are the masters of the financial universe hoarding it like squirrels before winter? Because they know the truth. They know that the dollar system is fraying at the edges. They know that sanctioned assets can be frozen. They know that in a world of geopolitical fragmentation and debt saturation, the only asset that has no counterparty risk is physical gold. When an institution that has the power to print money chooses an asset that cannot be printed, that is the loudest signal you will ever receive. They are front-running you. They are buying the insurance before the house catches fire while telling you that the smoke you smell is just a barbecue party. Do not be a fool. Do not listen to their words. Watch their hands. The Federal Reserve, the European Central Bank, the Bank of Japan, they are not independent guardians of stability. They are political entities tasked with keeping a dying system on life support for as long as possible, and the medicine they use is your purchasing power. By the year 2026, as huge amounts of government debt mature and need to be refinanced at higher rates, the pressure to print money will become overwhelming. The liquidity floodgates will open. And when that flood of new currency hits the system, where will it go? It will flow into real assets. It will flow into things that cannot be diluted. This is why understanding the debt trap is crucial. It explains why the old rules don't work anymore. In the past, you could save cash and be safe. Today, cash is a melting ice cube. In the past, bonds were risk-free return. Today, bonds are return-free risk. The entire landscape has shifted. The tectonic plates of the global economy are grinding against each other, and the earthquake is coming. So, we have established that the system is rigged. We have established that the debt is unpayable. And we have established that the central bankers are hypocrites who are secretly loading up on gold. Now, we need to talk about your shield. We need to talk about gold, not as a speculation, but as the only thing standing between you and the inevitable consequences of this monetary madness. But be warned. Owning gold is not as simple as buying it and forgetting it. There's a right way and a wrong way. Let us get one thing straight. If you are buying gold because you want to get rich quick, you are in the wrong asset class. Go buy a lottery ticket. Go speculate on some digital meme coin that was created by a teenager in his basement. Gold is not a growth engine. It is not designed to double in value every 6 months. It is not exciting. In fact, it is incredibly boring. It sits there, it does nothing, it pays no dividends, it earns no interest. And that is exactly why you need it. Gold is insurance. It is wealth insurance. It is fire insurance for your financial house. You do not buy fire insurance hoping your house burns down so you can get rich. You buy it so that if the house does burn down, you are not sleeping under a bridge. In the context of the year 2026, gold plays a specific role. It is the anchor. Imagine the global economy is a ship sailing into a massive storm. The waves are debt, the wind is inflation, and the captain is a central banker who has had too much to drink. When that ship starts to toss and turn, when the engines fail, you do not want to be holding on to the sails. You want to be connected to the anchor. Gold protects purchasing power. That is its only job, and it does it perfectly. An ounce of gold in ancient Rome could buy a high-quality toga and a pair of sandals. An ounce of gold in the year 1920 could buy a fine tailored suit. An ounce of gold today can still buy a fine tailored suit. The currency has changed, the empires have risen and fallen, technologies have revolutionized the world, but gold has kept its value constant. Now, compare that to the US dollar. Since the Federal Reserve was created in 1913, the dollar has lost over 98% of its purchasing power. It is not a store of value. It is a slow-motion train wreck. The biggest mistake men make heading into a crisis is misunderstanding what gold is for. They treat it like a stock. They look at the chart every day. They say, "Oh no, gold is crashing. I need to sell before I lose money." This is weak. This is emotional. This is exactly what the predators want you to do. You have to stop thinking in terms of price and start thinking in terms of value. When the price of gold goes down in dollar terms, it does not mean gold is worth less. It usually means the dollar is temporarily strong, or that paper derivatives are being sold to manipulate sentiment. Real investors, the ones who survive generations, they do not sell their insurance when the sun is shining, and they certainly do not sell it when they smell smoke. Gold acts as a credibility hedge. When trust in the government is high, gold tends to be quiet, but when trust breaks down, gold screams. As we approach 2026, we are looking at a complete breakdown of trust. Trust in the budget, trust in the currency, trust in the geopolitical order. In that environment, gold becomes the only adult in the room. It is the only asset that does not rely on a politician's promise. It does not rely on a CEO's earnings report. It does not rely on the electricity grid working. It just is. It is condensed energy. It is condensed history. It is the ultimate form of payment that cannot be frozen or canceled. But here's the hard part. Holding gold requires discipline. It requires the ability to sit still when everyone else is running around like headless chickens chasing the latest fad. You will see the stock market rally. You will see your neighbor bragging about how much money he made on tech stocks. You will feel the fear of missing out. But you have to remember, in a debt saturation cycle, most of those gains are nominal illusions. They are earning more currency units, but those units are buying less stuff. It's like measuring your height with a shrinking ruler and thinking you are growing taller. Gold is the constant ruler. However, while gold is your shield, your defense, your anchor, there is another metal that plays a very different role. It is wilder, it is more dangerous, but it offers something gold cannot: leverage. I am talking about silver, the devil's metal. If gold is the shield, silver is the volatile sword, and if you handle it wrong, you will cut yourself. If gold is the aristocrat of metals, dignified, stable, boring, then silver is the crazy bipolar cousin who shows up to the family reunion drunk and starts a fistfight. Silver is not gold's little brother. Stop thinking of it that way. It is a completely different animal. It is a hybrid monster, part money, part industrial commodity. This dual nature is what makes it so explosive and so dangerous. On one hand, it has a monetary history almost as long as gold. When confidence in fiat currency collapses, money flows into silver for the same reason it flows into gold, to escape the system. But on the other hand, silver is an industrial workhorse. It is the most conductive metal on the periodic table. You cannot build the modern world without it. You want a green energy revolution? You need silver. Photovoltaic solar panels devour massive amounts of silver paste. You want electric vehicles? Every single EV uses almost twice as much silver as a combustion engine car. You want 5G networks, smart electronics, medical devices, Tomahawk missiles? They all need silver. Here is the critical difference. Gold is hoarded. Almost every ounce of gold ever mined still exists in a vault or on someone's finger. Silver is consumed. It is used in tiny amounts in billions of devices and then thrown into landfills. It is disappearing. Above-ground stockpiles have been falling for years. We're heading into the year 2026 with a structural supply deficit. The miners cannot dig it out of the ground fast enough to meet the demand. Ore grades are falling. New mines take 10 years to come online. So you have shrinking supply meeting rising demand, plus a potential monetary panic. This is the recipe for a super spike. But, and this is a massive but, you have to survive the ride. Silver is often called the devil's metal for a reason. It is designed to shake you out. It will do nothing for years. It will bore you to tears. Then it will drop 30% in a month just to test your faith. And right when you puke up your position and sell at the bottom, it will turn around and triple in value. It is volatile. It is violent. When gold moves 1%, silver often moves 2 or 3% in both directions. If gold is your shield against poverty, silver is your sword to attack the inflation. It offers leverage. If we see a true currency crisis in the year 2026, gold might go up 2 or 3 times, but silver, because it is such a tiny market, could go up 5 times, 10 times, or more. The market is so small that if just a fraction of global capital tries to squeeze through the door, the price has nowhere to go but vertical. But this potential reward comes with a price. The price is your sanity. Most men cannot handle silver's volatility. They buy it when it is hyped on the news. They buy at the top. Then the price crashes. They panic. They feel stupid. They sell. This is why allocation matters. You do not put your grocery money into silver. You do not put your rent money into silver. You put the money that you can afford to watch drop by 50% without blinking, because if you can hold through the drop, the upside on the other side of the crisis is life-changing. So, we have the shield, gold. We have the sword, silver. Now comes the most important part of this entire discussion, the part where the rubber meets the road. How do you actually structure this? You can't just guess. You can't just throw a dart at a board. You need a framework. You need numbers. You need a strategy that keeps you solvent while the rest of the world is going bankrupt. How much is actually enough? Is it 5%? Is it 50%? Let's stop the theory and get into the tactics. In the next section, I'm going to give you the exact ratios, the specific numbers, and the allocation strategy for the year 2026. Meaningful protection is between 10% and 25% of your investable net worth. Let me repeat that, 10% to 25%. Below 10%, it is just a hobby. It will not move the needle. Above 25%, you start to run into liquidity issues and opportunity costs, unless you are already extremely wealthy and just trying to stay that way. Now, within that allocation, how do you split the shield and the sword? How do you balance gold and silver? This depends on your personality. Are you a predator or are you a protector? For the conservative protector, the man who wants to sleep at night, the man who cannot tolerate seeing his account balance swing wildly, the ratio is roughly 2/3 gold and 1/3 silver. This gives you the stability of gold, the anchor, while giving you a little bit of exposure to the explosive upside of silver. It is balanced, it is sensible, it is the strategy for the family man. For the aggressive investor, the predator, the man who looks at the central banks and wants to bet against their incompetence, you might tilt closer to 50-50, half gold, half silver. This increases your volatility significantly. Your portfolio will swing like a pendulum in a hurricane. But if we get the squeeze, if silver does what it did in 1980 or 2011, the returns will be astronomical. But choose your lane carefully. Do not try to be a predator if you have the stomach of a prey. You will panic sell at the bottom. I guarantee it. Now, a critical warning about how you own it. In the year 2026, counterparty risk will be the name of the game. Banks will fail, brokerages will freeze accounts, systems will crash. If you hold your gold and silver in a paper ETF or a digital certificate or an unallocated pool account, you do not own metal. You own a promise. You own a claim on a counterparty. And in a crisis, promises are broken. If you cannot hold it in your hand, if you cannot drop it on your foot and feel pain, you do not own it. You must have a core position in physical metal, coins, bars, real tangible wealth that is outside the electronic banking system. This is your go-to-hell money. This is the money that works when the lights go out. However, do not be stupid. Do not put every single dollar you have into metal. You still need liquidity. You still need cash for emergencies. The worst thing you can do is buy gold today and then be forced to sell it next month to pay for a broken car transmission or a medical bill. If you are forced to sell insurance during a calm period, you lose the premium. Build a cash buffer first, then build your metal position. The goal is not to maximize returns. The goal is to minimize regret. Imagine standing in the year 2026, looking back at today. Will you regret buying too much insurance? Probably not. But will you regret holding a pile of worthless paper while the cost of living explodes? Absolutely. We are almost at the end. In the final part, we are going to wrap this up with the verdict for the future. The window is closing, and you have a decision to make. We have looked at the history, we have crunched the numbers, and we have stared into the abyss of the debt trap. Now, we are standing at the edge of the cliff. The year 2026 is not some distant science fiction future. It is right around the corner. The clock is ticking, and every second that passes is a second where the window of opportunity closes just a little bit more. You need to understand one fundamental law of economics. Wealth is never destroyed. It is only transferred. When the stock market crashes, the wealth does not vanish. It moves from the impatient to the patient. When the currency collapses, the wealth does not disappear. It moves from those holding paper to those holding things. This is the great wealth transfer, and it is going to be the defining event of your lifetime. You have a choice to make right now. You can choose to be the victim. You can choose to believe the lies on the television. You can keep your wealth in a system that is designed to confiscate it through inflation. You can sit there and hope that the politicians will fix it. Or you can choose to be the architect of your own survival. You can choose to take possession of your labor, to store your energy in the only batteries that have never failed in 5,000 years, gold and silver. The question of how much is enough is not just about a percentage in a spreadsheet. It is about freedom. Enough is the amount that allows you to stand tall when others are kneeling. Enough is the amount that allows you to feed your family when the supply chains break. Enough is the amount that ensures that when the dust settles on the financial reset, you are not starting from zero, you are starting from a position of strength. Do not wait for the crisis to be announced on the news. By the time the panic is visible, it is already too late. The premiums will be astronomical, the inventory will be gone, and you will be left holding a bag of confetti. Position yourself now while the waters are relatively calm, while the prices are still suppressed by the paper games. Be the predator, not the prey. Be the one who prepared, not the one who regretted. The system is shaking. The cracks are visible. The central banks are buying. What are you doing? This is not just about money. This is about legacy. This is about survival. Get your gold, get your silver, get your house in order, because when the year 2026 arrives, you will either be glad you did or you will wish you had listened to this video. The choice is yours, but remember, fortune favors the bold and it punishes the blind.